All right. Good afternoon, everybody. Welcome to our financial statement analysis group report slash case study for our Finance 600-01 seminar in business finance class, led by our professor Rafael Mari for the summer term of the year 2025. Our group members consisted of Matthew Alvarado, Katie Bradshaw, Jonathan Cortes, Zachary Kinnoin, Jassia Mushtaq, and Chatuda Xiong. We put together this presentation and we will be going over various ratios that we calculated for the Walmart company, diving into what each of these ratios means, what they signify, and providing a summary of our findings, as well as some recommendations based on the exercise that we walked through here. Firstly, we'll be going over what we categorized as profitability and efficiency ratios. The ratios that fell into this category consisted of return on assets, operating profit margin, and sales to assets ratio, otherwise also known as asset turnover ratio. Starting off with the first one for return on assets, this ratio measures how effectively a company uses its assets to generate earnings, and it provides insight into operational performance and asset efficiency across all business activities. According to our textbook, return on assets is calculated by taking after-tax interest plus net income divided by the total assets. Taking the values that were provided for us in the problem set, we took 1 minus the tax rate of 21% multiplied by the interest, 2,599, to go ahead and take the after-tax interest plus the given net income of $15,201 divided by the total assets of $236,495 to arrive at an ROA of 7.3%, effectively meaning that Walmart makes 7.3 cents for every dollar deployed on assets. Moving on to the second operating profit margin ratio, this ratio examines the proportion of sales revenue that turns into operating profit prior to interest and taxes. The reason we use this ratio is because it highlights the efficiency of core business operations and in controlling costs relative to sales. So, according to our textbook, operating profit margin is calculated by taking after-tax interest plus net income divided by sales. It resembles very closely with the return on assets ratio, except in this case, we divide over sales rather than total assets. So again, taking our after-tax interest by taking the 1 minus the tax rate of 21%, multiplying that by the interest of 2,599 plus the net income of $15,201 divided by the total net sales of $523,964. Taking all those given values, we arrive at an operating profit margin of 3.29%. And what this essentially means is that for every, say, $100 that Walmart generates, $3.29 remains after covering operating expenses before interest and taxes. Thirdly, we're going to go to the sales to assets ratio, also known as the asset turnover ratio. This ratio really reflects how many dollars in sales are generated for every dollar invested in assets. It helps determine asset turnover and operational efficiency. So again, according to our textbook, we take the sales divided by the total assets at the start of the year. Once again, that's sales divided by the total assets at the start of the year. So taking the given sales of $523,964 divided by the total assets at the start of the year being the 2018 total assets, $219,295, we arrive at a sales to asset ratio of 2.39%. And so with a 2.39 turnover, Walmart generates $2.39 in sales for every dollar they invest in assets. All in all, the ROA, operating margin, and sales to assets ratios of Walmart really illustrate an effective asset use and operational control, but moderate profitability directs attention to cost management. So with that, I'll go ahead and turn it over to my teammate, Matthew Alvarado, who's going to be talking a little bit more about inventory turnover.
And I'm going to go ahead and talk about the inventory turnover of Walmart. So inventory turnover is an important key performance indicator in a business because it tells you how well the business is managing their inventory and generating sales. So by definition, inventory turnover indicates the number of times inventory is sold and replaced during a period. It's the amount of times that a company buys and sells inventory. And in the case of Walmart, which is the company that we're studying in this case study, we ended up getting an inventory turnover of 8.91. And the way that we arrived at that number is we took the cost of goods sold and we divided it by the inventory in the year of 2019. So 8.91 is a high inventory turnover, and for the most part, the higher the inventory turnover, the more favorable it is for a business, and the lower the inventory turnover, the less favorable it is for a business. In the case of Walmart, a high inventory turnover indicates inefficient inventory management of the company, because they are, they're a grocery company. They sell groceries, and so they don't want groceries staying in their warehouses for too long, because then they spoil, they perish, and they're unable to sell their product. And so the fact that Walmart has a high inventory turnover means that they're constantly moving their groceries out of their warehouses and selling them, which is a good thing for Walmart. And it's not only a good thing because of that, it's also a good thing because it reduces holding costs. And what holding costs are, they're basically the costs that are associated with holding your inventory in your warehouse. Costs like rent, utilities, insurance, theft, and other costs that are related to maintaining that inventory in your warehouse. And so in the case of Walmart, they have a high inventory turnover, and that means that they are selling their products, and it's ultimately a good thing for their company.
Thank you, Matt. Hi, everyone. I will be talking about leverage analysis and the debt to equity ratio. The debt to equity ratio compares debt to total shareholder equity and is one important indicator of a company's financial health. The ratio determines how much debt versus equity a company uses to finance its operations. Since debt must be repaid or refinanced, it imposes interest expenses that typically cannot be deferred. This can negatively affect or even destroy the value of equity in the event of a default. As a result, a high debt-to-equity ratio is often associated with high investment risk. It means that a company relies primarily on debt financing. In some cases, debt finance growth can increase earnings, and shareholders should expect to benefit if the profit increase exceeds the related rise in debt service costs, such as interest payments. The share price may drop, however, if the additional cost of debt financing outweighs the additional income it generates. The cost of debt can vary with market conditions, along with a company's ability to pay it back. Borrowing that seemed like the right decision at the time can prove unprofitable later as a result. The information to calculate the ratio is found on a company's balance sheet. It is calculated by taking the debt. In Walmart's case, it is $43,714,000,000, and dividing it by total shareholders' equity. In Walmart's case, $81,552,000,000, to get a ratio of 0.54. This means that for every $1 of equity that Walmart's shareholders have invested in the company, Walmart has 54 cents in debt. It is important to consider the company's industry when evaluating the debt to equity ratio. Different industries have different capital needs and growth rates, so a debt to equity ratio value that's common in one industry might be completely out of the normal in another. For example, utility stocks often have especially high debt to equity ratios because it is a highly regulated industry that typically makes large investments at a stable rate of return and generates a steady income stream. So utility companies borrow heavily and relatively cheaply. In some cases, the ratios can be at or above 3. In Walmart's case, the retail industry typically requires substantial investment in physical stores and other infrastructure like distribution centers. Many sectors of retail often have relatively thin profit margins, meaning there's less room for absorbing high fixed costs. Retail is also sensitive to economic cycles and consumer spending habits. For these reasons, many retail stores typically have debt to equity ratios close to or above 1. Walmart's debt to equity ratio of 0.54, therefore, means Walmart has significantly lower fixed interest payments and debt principal expenses than the typical retail chain. This provides a financial buffer during lean times and allows Walmart to absorb reduced sales or profitability better than highly leveraged competitors. Walmart's low debt burden also gives them added flexibility in strategic investments such as technology, store improvements, expansions, and even large acquisitions. In summary, Walmart's 0.54 debt to equity ratio shows that they rely heavily on their own financial resources and prioritize stability and long-term growth. It gives them significant financial flexibility and enables them to stay balanced during economic uncertainty and maintain a competitive edge. Now, I will pass it on to Jassia.
Thank you, Zach. Hi, everyone. Today, I'll be talking about two liquidity measures, the current ratio and the quick ratio, and what they tell us about Walmart's short-term financial health. Let's start with the current ratio. This ratio tells us if a company can pay off its short-term debts using its short-term assets like cash, inventory, and receivables. A healthy current ratio is usually above 1, which means the company has more assets than liabilities. But in Walmart's case, the ratio is 0.79, which is below 1. That means for every dollar of short-term liabilities, Walmart only has 79 cents in short-term assets. This suggests potential trouble in covering short-term obligations unless they improve their working capital management. Now let's look at the quick ratio. This ratio is also called the acid test ratio. It's a more strict version of the current ratio because it removes inventory and focuses only on the most liquid assets like cash and accounts receivable. Walmart has a quick ratio of 0.2, which means Walmart has only 20 cents of truly liquid assets for every dollar of current liabilities. That's very low, and it signals a high reliance on inventory sales to meet short-term debts. So what does it mean for Walmart? Both of these ratios suggest Walmart may face liquidity challenges. It could have a hard time paying its short-term bills if sales slow down or if inventory can be turned into cash quickly. This may not be an immediate crisis because Walmart has strong operations and cash flow, but it does highlight some financial pressure. In summary, Walmart's liquidity position is weak based on these ratios. It shows a need for better cash and receivables management to improve its ability to handle short-term obligations. As a next step, they might want to focus on speeding up collections and keeping tighter control of their expenses. Now, I'll invite Chatuda to summarize our findings on this case. Thank you.
Thank you, Jassia. My name is Chatuda Xiong, and I will be going over a comprehensive summary of our financial analysis of Walmart. Under profitability and efficiency, Walmart's return on assets reflects solid assessment utilization, especially for a company operating at such a large scale. However, the operating profit margin of 3.29% suggests that only a small portion of revenue is retained as operating profit after covering core expenses. This margin is relatively low for the retail sector and points to potential inefficiency or high operating costs. The sales to assets ratio of 2 reinforces Walmart's ability to generate significant revenue from its asset base, highlighting strong operational throughput and effective use of infrastructure. With an inventory turnover of 8.9, this means that Walmart cycles through its inventory almost 9 times per year. This is a strong indicator of efficient inventory management, especially in a retail environment where product freshness, shelf space, and responsiveness to demand are critical. High turnover reduces holding costs and minimizes the risk of obsolete inventory. However, it also requires precise demand forecasting and supply chain coordination to avoid stockouts or over-reliance on just-in-time inventory. Under leverage, the debt-to-equity ratio of 0.54 shows that Walmart uses a conservative mix of debt and equity to finance its operations. For every dollar of equity, the company carries only 54 cents of debt. This conservative use of debt helps minimize financial risk and interest expenses, giving Walmart more flexibility to navigate economic downturns or market fluctuations. It also positions the company well to take on additional debt if needed for strategic investments or expansion. With Walmart's current ratio of 0.79 and quick ratio of 0.2, both fall below the commonly accepted benchmarks of 1.0 and 0.5, respectively, indicating potential short-term liquidity concerns. These figures suggest that Walmart may not have enough liquid assets to cover its short-term liabilities, raising concerns about short-term financial health. The particularly low quick ratio indicates a heavy reliance on inventory to meet obligations, which could be risky if inventory cannot be quickly converted to cash. This highlights the need for improved cash flow management, faster receivables collection, and possibly a reevaluation of short-term liabilities. Overall, Walmart is operationally efficient and maintains a stable, low-risk capital structure. However, its modest profitability and weak liquidity position suggests areas for improvement. Enhancing cost control, optimizing working capital, and exploring strategic uses of leverage could strengthen Walmart's financial resilience and support long-term growth. Now I will pass it on to Katie.
Thank you, Chatuda. My name is Katie Bradshaw, and next I will be going over our team's recommendations based on our financial analysis of Walmart. First, Walmart needs to improve its liquidity. The current ratio looks at the firm's ability to cover short-term liabilities with short-term assets, and for Walmart, this is 0.79. The quick ratio looks at the company's ability to meet current obligations without using inventory, and for Walmart, this was 0.2. Both of these ratios fall below the generally accepted benchmark of 1.0. These ratios allude to a potential difficulty in covering short-term debt without relying on inventory. Our recommendation is to strengthen cash management practices and accelerate the collection of receivables. Optimizing payment cycles or providing earlier payment incentives will help provide a faster cash inflow. Additionally, better managing cash flow will improve liquidity. This will help Walmart reduce short-term financial stress and allow for more operational flexibility. Next, we recommend Walmart work towards enhancing operational efficiency. The operating profit margin, which looks at the proportion of sales revenue that turns into operating profits prior to interest and taxes, is currently 3.29% for Walmart. This is an acceptable market for the retail industry. However, there is still room for improvement. One strategy would be to eliminate cost inefficiencies and reduce overhead costs throughout their supply chain process. Looking at automation of certain streamlined activities could help reduce overhead costs. Improving the operations will boost profitability and strengthen Walmart's competitive position. Lastly, we suggest that Walmart maintain a balanced approach to debt usage to support potential strategic initiatives. Walmart's current debt-to-equity ratio, which shows their risk profile, is 0.54, which is considered conservative. The company is not overly reliant on debt and could strategically leverage debt for growth opportunities. For example, Walmart could invest in research and development of technology. Through this research and development, hopefully discovering a new technology that could advance Walmart's operations, or researching potential new markets to enter for Walmart. Leveraging debt should look at increasing the company's value without risking the stability of the company. This can be a difficult task and must be carefully monitored. In summary, we recommend that Walmart improve liquidity through smarter cash flows and receivables management, enhance efficiency by reducing operational costs, and use leverage wisely to support future growth. By focusing on these strategies, Walmart can build a stronger, more resilient financial foundation. Thank you.